All right, welcome to Talk Tickers. Today we're diving into Transocean's latest earnings, ticker RIG. And honestly, this one was a head-scratcher at first glance. You had revenue looking good, beating estimates, but then a big miss on earnings. So you'd expect the stock to take a hit, right? Wrong. It rallied. So the big question is, what did the smart money see that the headlines missed? Well, that's exactly what we're going to break down.
Okay, here's how we're going to tackle this. First, we'll hit those confusing headline numbers. Then, and this is key, we'll get into why cash flow is king for these guys. After that, we'll talk about the massive Valaris deal, a real game changer. Then, we'll look at the company's guidance and what they see coming down the pike. And finally, we'll wrap it up with our own analyst take, what we're calling the next call.
All right, let's jump right in. Section 1, the headline numbers. And yeah, this is really where the story splits in two.
So when the numbers first dropped, it really was a classic mixed bag. You look at revenue, and hey, not bad. They pulled in $1.04 billion, just squeaking by the $1.03 billion estimate. But then your eyes drift down to the bottom line, the earnings per share, and oof, just 2 cents. The street was looking for more like 8 cents. That's a pretty big miss, no two ways about it.
And predictably, that earnings miss spooked the early birds. In pre-market trading, the stock immediately fell, down almost 3%. You can just picture people hitting the sell button. But then, the market opened, the conference call started, and something shifted. By the time the closing bell rang, the stock had done a complete 180, finishing the day up over 2.5%. Wild, right?
So that really is the million-dollar question here, isn't it? The market clearly hated the earnings miss at first, so why the rally? What piece of information came out that made investors completely change their minds?
Well, the answer, as it so often is with these capital-intensive businesses, wasn't on the income statement. It's in the cash flow. And for a company like Transocean, which has been dealing with a lot of debt for a long time, let me tell you, cash is absolutely king. That's the real story here.
And here it is. This is the number that turned the tide. $321 million. That's their free cash flow for just one quarter. I mean, that's not just a good number, it's a monster number. It works out to a 31% margin, which is the best they've posted in years. Suddenly, that little earnings miss doesn't seem so important, does it?
And it's not like they're just sitting on that cash. Look at what they're doing with it. Over the entire year, they knocked down their debt by almost $1.3 billion. This, right here, is the ballgame. They're taking all this cash they're generating and using it to attack their biggest weakness, the balance sheet. And think about this. That one move saves them almost $90 million a year just in interest payments.
Now, this massive cash flow didn't just happen by magic. They're making it happen in two ways. First, they're getting super aggressive on costs. They managed to slash $100 million in expenses last year, and they're aiming for another $150 million this year. And second, they're just running their rigs better than ever. I mean, a record of nearly 98% uptime, that's just incredible execution. Okay, so they're generating cash, they're cutting costs, they're paying down debt. So what's next? Well, this all builds towards their biggest move yet, and that's the plan to acquire their rival, Valaris.
And we are talking about a massive deal here. It's an all-stock transaction worth nearly $6 billion. You're essentially taking two of the biggest players in offshore drilling and smashing them together. Management thinks they can get this done in the back half of the year, and when they do, they'll be the undisputed king of the hill.
So why do it? Well, the strategy's pretty straightforward, but it's really powerful. Step 1, scale. You combine these two incredible fleets and basically own the deepwater market. Step 2, synergies. They're targeting over $200 million in cost savings just by combining operations. And step 3, and this is the big one, accelerate. You take the combined cash flow and just pour gasoline on that debt reduction fire.
And the CEO, Keelan Adamson, didn't mince words on the earnings call. He basically said, look, this combination allows us to address unnecessary cost. He's saying there's a lot of overlap, a lot of fat to trim, and this deal is all about getting lean and efficient. And of course, all those savings, they drop right to the bottom line.
Okay, so you have this massive merger on the horizon. With that in mind, let's talk about what management is seeing for the future, both for themselves and for the market as a whole.
Looking ahead to 2026, they're basically saying that the huge free cash flow we saw in 2025, yeah, expect that again or even better. But here's the really interesting part. That guidance is actually pretty conservative. They've built in some downtime for a few of their rigs. So what does that mean? It means if they can get those rigs contracted out, there's some serious potential for them to beat their own numbers.
And it's not like they're just being hopeful. They have every reason to be bullish, because the entire global deepwater market is heating up. I mean, you look around the world. Africa's adding rigs, India just put out a new tender, Norway is almost completely sold out. It's a strong picture everywhere. And what happens when demand goes up and the number of available rigs gets tight? You get pricing power. It means they can charge more per day. That's the day rate. And that flows right into cash flow. Okay, so that brings us to the big finale, the next call. This is where we put it all together and give you our analyst take on Transocean and what we're expecting from here on out.
So our official rating here at Talk Tickers is outperform. We think the company has hit a major inflection point. For years, the story around Transocean was about survival. Now, it's all about cash generation and paying down debt. It's a whole new narrative. So let's break down the thesis. First, stock price. Over the next 12 months, we see this hitting $8, maybe even higher. The rationale is simple. The market is going to start valuing this company based on its incredible cash flow, especially after the merger. Now, what should you watch for next quarter? It's all about that Valaris deal. Any positive news on getting that deal approved or how they're planning to save money will be a huge catalyst for the stock. Of course, there's always a risk. For Transocean, the big one is a macro slowdown. If oil prices take a nosedive, customers could delay projects, and that would definitely hurt.
And of course, we have to say it. This has all been for informational purposes. This is not financial advice.